Get ready to discover why everything you think you know about beating the stock market is probably wrong. Today we're diving deep into Burton Malkiel's legendary book, A Random Walk Down Wall Street. And I'm warning you right now, this video might completely change how you think about investing forever. Imagine walking into a casino where the house always wins, except this casino is called Wall Street, and millions of people pour their life savings into it every single day, believing they can outsmart the system. What if I told you there's a Princeton economics professor who spent decades proving that throwing darts at a stock chart might actually give you better returns than most professional fund managers? Sounds crazy, right? Well, buckle up, because we're about to explore one of the most controversial and influential investment books ever written. As someone who's analysed thousands of books across every genre imaginable, I can tell you that A Random Walk Down Wall Street stands out as a game changer that has sparked heated debates in boardrooms and coffee shops for over 50 years. This isn't just another dry finance textbook. It's a bold challenge to an entire industry built on the premise that experts can predict market movements and beat average returns. Burton Malkiel didn't just write a book, he launched a revolution that fundamentally questioned whether active investing and stock picking actually work. His research revealed shocking truths about mutual fund performance, the efficiency of markets, and why your grandmother's simple index fund strategy might outperform Wall Street's brightest minds. We'll break down his most explosive findings, examine the evidence that turned the investment world upside down, and show you exactly how his insights can transform your financial future. Published in 1973 and continuously updated through multiple editions, A Random Walk Down Wall Street emerged during a time when Wall Street was dominated by confident stock analysts and fund managers who promised to beat the market through superior stock selection and market timing. Burton Malkiel, a Princeton University economics professor with extensive experience in both academia and Wall Street, decided to put these claims to the ultimate test using rigorous statistical analysis and decades of market data. The book's title refers to the random walk theory, which suggests that stock price movements are essentially unpredictable and follow a random pattern, much like a drunk person stumbling down the street with no clear direction. This concept directly challenges the fundamental assumption underlying most investment strategies that past price movements and company analysis can reliably predict future stock performance. Malkiel brings unique credibility to this topic, having served on the boards of several major corporations and worked as an investment advisor, giving him insider knowledge of how Wall Street actually operates behind the scenes. His academic background in economics, combined with practical investment experience, allows him to bridge the gap between theoretical finance and real-world application. What makes this book particularly powerful is Malkiel's willingness to challenge sacred cows in the investment industry. He systematically dismantles popular investment theories, from technical analysis to fundamental analysis, using hard data rather than opinion or speculation. The book presents compelling evidence that most professional investors consistently fail to outperform simple market indexes over extended periods, despite charging substantial fees for their supposed expertise. The timing of the book's original publication coincided with the rise of academic finance theory and the development of modern portfolio theory. Malkiel helped popularize these concepts for general audiences while providing practical investment advice based on empirical research rather than market folklore or intuition. A Random Walk Down Wall Street systematically examines various investment strategies and theories to determine which approaches actually generate superior returns for investors. Malkiel organizes his analysis around two main schools of investment thought, technical analysis and fundamental analysis, before presenting his case for passive index investing as the optimal strategy for most people. The book begins by exploring technical analysis, the practice of using historical price charts and trading volume data to predict future stock movements. Malkiel presents extensive evidence showing that technical analysis fails to provide consistent, profitable signals, comparing it to reading tea leaves or consulting astrologers for investment advice. He demonstrates how numerous academic studies have found no correlation between past price patterns and future performance. Next, Malkiel tackles fundamental analysis, which involves evaluating companies based on their financial statements, management quality, competitive position, and growth prospects. While acknowledging that fundamental analysis has more logical appeal than technical analysis, he shows how even professional analysts with access to sophisticated research tools and company management consistently fail to identify undervalued stocks or predict earnings accurately. The core of Malkiel's argument rests on the efficient market hypothesis, which states that stock prices already reflect all available information, making it impossible to consistently find mispriced securities. He explains how thousands of professional analysts and sophisticated institutional investors create such intense competition that any edge quickly disappears as soon as it's discovered. Malkiel then introduces the concept of index investing, demonstrating how broad market index funds consistently outperform actively managed funds after accounting for fees and taxes. He provides compelling data showing that over long time periods, very few actively managed funds beat their benchmark indexes, and those that do succeed often fail to repeat their performance. The book concludes with practical advice for building investment portfolios using low-cost index funds, appropriate asset allocation based on age and risk tolerance, and the importance of maintaining discipline during market volatility. Malkiel begins his systematic destruction of popular investment myths by examining technical analysis in excruciating detail. He presents study after study showing that chartists who claim to identify patterns like head and shoulders, formations, support and resistance levels, and moving average crossovers perform no better than random chance. One particularly devastating piece of evidence involves computer programs that generated completely random stock charts, which technical analysts confidently interpreted as showing clear buy and sell signals. This demonstrates how human pattern recognition creates false confidence in meaningless data. The assault on fundamental analysis proves equally thorough and damaging to conventional investment wisdom. Malkiel reveals how securities analysts consistently overestimate earnings growth for companies they recommend while underestimating growth for companies they dislike. He shows how analyst recommendations tend to cluster around consensus views, creating herding behavior that eliminates any potential edge. Perhaps most shocking, he demonstrates that companies favored by analysts actually underperform the market on average, suggesting that popular stocks are typically overpriced. Malkiel dedicates substantial attention to debunking the myth of superior mutual fund performance. His analysis reveals that roughly 2/3 of actively managed mutual funds underperform broad market indexes in any given year, and over longer periods the failure rate increases dramatically. He calculates that after accounting for management fees, transaction costs, and tax implications, the vast majority of active funds destroy wealth compared to simple index investing. Even funds that do outperform often fail to maintain their edge, suggesting that past performance provides no reliable guide to future results. The book explores fascinating psychological factors that drive poor investment decisions among both professional and individual investors. Malkiel explains how overconfidence leads people to trade too frequently, destroying returns through excessive transaction costs and poor timing. He describes how loss aversion causes investors to hold losing positions too long while selling winners too quickly, the exact opposite of optimal strategy. Mental accounting errors lead people to treat different pots of money differently, creating suboptimal overall portfolios. Malkiel presents compelling evidence for market efficiency by examining how quickly stock prices adjust to new information. He shows how earnings announcements, merger announcements, and other material events get reflected in stock prices within minutes or hours, leaving no opportunity for ordinary investors to profit from public information. This speed of adjustment explains why even professional investors with sophisticated research capabilities struggle to find genuine bargains in the market. The book's treatment of market bubbles provides crucial insights into how even efficient markets can experience periods of extreme mispricing. Malkiel examines historical bubbles from the Dutch tulip mania to the dot-com boom, showing how psychological factors can drive prices far from fundamental values for extended periods. However, he argues that predicting the timing and magnitude of bubble bursts remains impossible, making market timing strategies unreliable even when overvaluation seems obvious. Malkiel's analysis of portfolio construction demonstrates why diversification represents the only free lunch in investing. He explains how combining assets with different risk characteristics can reduce overall portfolio volatility without sacrificing expected returns. His mathematical proof shows why holding broad market indexes provides superior diversification compared to stock-picking strategies that inevitably concentrate risk in specific companies or sectors. The book concludes with detailed practical guidance for implementing passive investment strategies. Malkiel provides specific recommendations for asset allocation based on age and risk tolerance, explains the tax advantages of index funds in taxable accounts, and addresses common objections to passive investing. He emphasises the importance of maintaining discipline during market downturns when emotional pressure to abandon long-term strategies reaches its peak. The most fundamental lesson from a random walk down Wall Street is that markets are far more efficient than most people realise, making consistent outperformance extremely difficult even for sophisticated professional investors. This efficiency stems from intense competition among thousands of highly educated analysts armed with advanced technology and substantial resources. When any potential edge gets discovered, it quickly disappears as others exploit the same opportunity, driving prices back to fair value. Investors must understand that fees and expenses represent a huge drag on long-term returns that compounds devastatingly over time. Malkiel demonstrates how a seemingly modest 2% annual management fee can reduce total returns by 30% or more over several decades due to the power of compounding. This mathematical reality explains why low-cost index funds consistently outperform expensive, actively managed alternatives, since they provide market returns minus minimal expenses rather than uncertain excess returns minus substantial fees. The book teaches that successful investing requires discipline and emotional control rather than superior analytical ability or market timing skills. Malkiel shows how psychological biases like overconfidence, loss aversion, and herding behaviour lead investors to make costly mistakes repeatedly. The most successful strategy involves developing a sensible long-term plan based on appropriate risk tolerance and sticking to it regardless of short-term market volatility or emotional impulses to change course. Diversification emerges as the single most important risk management tool available to investors. Malkiel's mathematical analysis proves that holding broad market indexes provides far superior risk-adjusted returns compared to concentrated portfolios of individual stocks. Even professionally managed portfolios rarely achieve the diversification benefits of simple index funds due to style constraints and active management decisions that increase concentration risk. The book reveals that market timing represents one of the most destructive investment behaviours despite its intuitive appeal. Malkiel presents extensive evidence showing that investors who attempt to time the market consistently underperform those who maintain steady positions through market cycles. The difficulty of correctly predicting both when to exit and when to re-enter the market makes timing strategies mathematically unlikely to succeed over multiple market cycles. Malkiel emphasises that starting early and investing regularly represents the most powerful wealth-building strategy available to ordinary investors. The magic of compound returns means that time in the market far outweighs timing the market for building long-term wealth. He demonstrates how consistent monthly investments in broad market indexes can generate substantial wealth over decades, even for investors with modest incomes who cannot afford sophisticated investment strategies. The book teaches that tax efficiency should play a major role in investment decisions for investors in taxable accounts. Malkiel explains how index fund provides superior tax efficiency compared to actively managed funds due to lower portfolio turnover and more predictable capital gains distributions. He shows how tax-aware investing can add substantial value over time, particularly for investors in higher tax brackets who face steep rates on investment income. Understanding the relationship between risk and return represents another crucial lesson from Malkiel's analysis. He explains how investors cannot expect to achieve superior returns without accepting commensurate risk, and how attempts to find high-return, low-risk investments typically lead to disappointment or outright fraud. The book provides practical guidance for determining appropriate risk levels based on individual circumstances and time horizons. Malkiel's work demonstrates the importance of maintaining proper perspective during inevitable market downturns. He shows how every major market decline in history has eventually been followed by recovery and new highs, rewarding investors who maintain discipline and continued investing through difficult periods. This historical perspective provides crucial context for weathering temporary market volatility without abandoning sound long-term strategies. Finally, the book teaches that simplicity often beats complexity in investment strategy. Malkiel's research consistently shows that sophisticated active management techniques fail to justify their additional costs and complexity compared to straightforward index investing approaches. This lesson applies not just to individual stock selection, but to complex alternative investments, market timing systems, and other supposedly advanced strategies that promise superior returns but rarely deliver. A Random Walk Down Wall Street stands as one of the most important and controversial investment books ever written, fundamentally challenging the entire active management industry while providing a roadmap for ordinary investors to achieve superior long-term results. Malkiel's systematic dismantling of popular investment myths using rigorous academic research and real-world data has influenced generations of investors and helped spawn the massive index fund industry we see today. What makes this book particularly valuable is its combination of theoretical rigour with practical applicability. Malkiel doesn't just criticise existing approaches, he provides specific actionable advice that readers can implement immediately to improve their investment results. His recommendations for asset allocation, fund selection, and portfolio rebalancing offer a complete investment framework suitable for investors at all experience levels. The book's enduring relevance becomes clear when examining how financial markets have evolved since its original publication. Despite massive changes in technology, globalization, and market structure, Malkiel's core insights about market efficiency and the futility of stock picking remain as valid today as they were 50 years ago. If anything, increased competition and faster information flow have made markets even more efficient, strengthening his arguments against active management. Perhaps most importantly, A Random Walk Down Wall Street provides intellectual ammunition for investors to resist the constant bombardment of complex investment products, market predictions, and get-rich-quick schemes that dominate financial media. By understanding the mathematical and empirical evidence supporting passive investing, readers can maintain confidence in simple strategies while others chase the latest investment fads. The book ultimately delivers a liberating message for individual investors. Rather than spending countless hours researching stocks, timing markets, or searching for the next hot fund manager, investors can achieve superior results through disciplined implementation of boring but effective index investing strategies. This approach not only produces better financial outcomes, but also frees up time and mental energy for more productive and enjoyable pursuits than obsessing over daily market movements.